Joining us to discuss the health of the regional banks and the risks that may still be out there is Tom Michaud. He's president and CEO of KBW, a Stifel company. Tom, always good to have you.
Morning, David.
Good morning. First of all, let's just start off with this New York Community Bank, which we haven't seen the deposit flight, and that seems to be the concern. But give me your overall take there in terms of whether there's any chance it could be systemic and, if it sort of portends future concern overall for the regional banking sector.
Yes, I think what we've learned is that a lot of these risks are idiosyncratic, very company specific, and I think that's what's happening at New York Community right now. Our analysts and the marketplace, I think, understands that commercial real estate is under a lot of pressure at the moment, but I think it's very segmented. And when you think about large commercial properties in big urban centers, especially on the coast, that's an area of worry. When you think about multifamily properties that are rent controlled, where rate adjustments, interest rate adjustments, where inflation and the fact that they couldn't raise rents during COVID has put a lot of pressure on that market. And then also what we've learned with New York Communities, they have a very concentrated portfolio, and concentration is another story from last spring. I think it's at play here. So I think that while the entire industry, the entire market is going to see more pressure from certain areas of commercial real estate, I don't think what's happening at New York Community is a signal for what's going to happen to the whole industry.
Yeah, regardless of that, do the regional banks end up in the penalty box still for some time, or are they past the tumult of last spring?
So what I think they are past the tumult from last spring, because I think one of the major takeaways is that the industry is very resilient. I mean, while there were three banks that failed rather spectacularly, there were all specific reasons why that happened. Remember, 4,700 banks didn't fail. So again, we should understand the reasons for why those banks failed. But our view is we have a market perform rating from our research group on the group, because we do think that it's going to be choppy. However, we have some fantastic ideas of individual stocks where we think there are companies that have navigated away from the areas of highest risk and offer very good upside for investors. So we are really positive on a couple of ideas, but we haven't put a broad blanket buy on the group yet for some of these concerns.
I do wonder how much of it was the regulatory actions taken by the FDIC, but maybe more importantly, the Treasury over that very dramatic weekend where they came out and guaranteed the depositors of Silicon Valley Bank. And I know there were questions from there about whether all bank deposits were guaranteed, but the upshot of it was that they're willing to do that. And the signal is that you don't have to worry.
Well, so you hit the nail on the head. Banks fail because of deposit runs. They happen about every 10 or 15 years in modern American history. I think the biggest piece of unfinished business is we did not get deposit insurance reform post this crisis. Instead, we got a lot of hardening of capital rules, which were not the reasons why those banks failed. They failed. If you read the FDIC report, according to what I read, it looks like 85% of the deposits of Silicon Valley Bank flew in 48 hours. That is a bank run. So I believe that the right solution to last spring is to modernize FDIC insurance and to raise the limits for small businesses so they can keep their payroll accounts in an insured bank with confidence. I also think the FDIC should offer additional privately purchased insurance from banks, which is a private market solution. I talked about both those things in front of Congress last spring myself, but Congress is not moving.